Right now, we are witnessing an absolutely critical transition in the markets. We're talking about a rapid structural shift away from that narrow megacap tech dominance and into a much broader participation base. Welcome to this week's Premium Market Intelligence Briefing, where we track exactly where that capital is migrating and how you can position yourself ahead of the curve.
Okay, let's dive right into this. In today's explainer, we're taking a strict, no-nonsense look at the current market regime, our macro catalysts, where pro traders are focusing right now, the tactical playbook, and, of course, the risk matrix. Let's start with Section 1, the current market regime, which we're defining as selective risk-on. So to really understand the current weather of the market, we have to look at our Shadowfox conviction score. Right now, it's sitting at 61 out of 100. What does that mean for us? Well, it signals that we're squarely in a transition phase. The trend here is structurally positive, for sure, but it is a selective risk-on environment. That means it absolutely demands rigorous quality filters. You literally cannot just buy the index blind right now. The market is telling us quite clearly what this selective risk-on regime looks like. Look at the S&P and the Nasdaq. Both are holding firmly above their 200-day moving averages. But the real story here? Breath repair. We're seeing advance and decline lines expanding right into industrials and financials. Meanwhile, volatility is staying suppressed, with the VIX anchored comfortably sub-15. Add in a stable Fed balance sheet runoff, and macro liquidity is serving as a very nice neutral to stable tailwind. Moving on to Section 2, macro catalysts. Let's look at exactly what moved markets this week. And this brilliantly illustrates where we stand. Our scenario engine is pointing to a 60% probability for our base case. And this whole scenario hinges heavily on one dominant force. Mid-year earnings need to validate the massive AI CapEx monetization narrative. Basically, we're waiting to see if all this heavy capital expenditure by the hyperscalers and enterprises is actually translating into durable free cash flow. Now, on the macro front, we're seeing a real tug-of-war. On one hand, we're seeing real sticky disinflation, with core CPI stubbornly hanging around that 2.6% mark. But on the flip side, the labor market is softening. ADP employment just cooled to under 100K. So this dynamic is really fueling the ongoing debate across trading desks everywhere. Are we actually heading for a soft landing, or are we going to see inflation reaccelerate? We also had some major corporate news shaking things up. Paramount is delaying its massive $110 billion Warner Brothers Discovery acquisition. It's now being pushed as far out as June 2027 because of a legal challenge from the New York Attorney General. To put that into perspective, this delay triggers a massive potential taking fee of $1.7 billion. They're risking $7 million a day just to get their day in court. Unbelievable. Over in global policy, we saw the implementation of new Section 301 tariffs. We're talking 10 to 12.5% across 60 nations. Interestingly, the market kind of shrugged this off. It was mostly absorbed as a necessary evil for federal revenue generation, rather than a reason to panic. But putting our strategist hats on, we have to objectively recognize that this remains a latent supply shock risk. It could definitely impact global supply chains down the road. Let's move to Section 3 and see how this builds. Pro-trader focus and the migration of capital. The key question this week is exactly where institutional trading desks are allocating their capital in response to all of this. Well, they are hyper-focused on what we call the bottleneck trade. This is essentially the constant migration of institutional capital as one supply constraint is resolved and then another one emerges. Pro traders are actively tracking this capital as it rotates away from pure-play hardware and into the next layer of constraints. Think high-performance memory and internal data center power infrastructure. I think our CIO, Frances Newton, hit the nail on the head recently. She said, AI CapEx is always intact, it just moves to the next bottleneck. The enthusiasm around artificial intelligence isn't dying down at all. It's just that the massive liquidity in the system is fluidly searching for the very next unresolved constraint to monetize. So how exactly do you trade these shifting bottlenecks? Well, this leads institutional desks directly into heavy asset, low obsolescence plays. We're talking about physical infrastructure that AI is going to greatly enhance, but fundamentally cannot replace or disrupt. Think of your foundational assets, things like railroads and heavy industrial machinery. All right, Section 4, the tactical playbook. Let's look at some A-plus actionable setups. Now, what's really interesting here is how we translate this intelligence into actionable trades.
Notice how these top 5 liquid, institutional-grade equities strictly adhere to our regime lens: Apple, Dell, CSX, Deere, and Dominion Energy. They are all showing incredible momentum, trading well above their critical 50-day and 200-day moving averages, and they're doing this across entirely distinct sectors. For the swing traders tuning into this explainer, Apple and Dell are going to be your high beta trend vehicles. The optimal execution strategy here is to target intraday or daily pullbacks right toward that 50-day moving average. You want to use that exact level to clearly define your risk, rather than chasing extended, volatile gaps, especially in thin summer trading. Now, on the flip side, long-term investors should be utilizing names like CSX and Deere as breadth confirmation trades. These are essentially your proxies for the industrial rotation we mentioned. By accumulating these quality cyclicals on controlled pullbacks, you're aligning your portfolio perfectly with the broader TAPEX and reshoring cycles we just broke down. Which brings us to Section 5, the risk matrix. Let's talk about the vulnerabilities. As a market strategist, I always have to ask the hard question: what could actually break our bullish thesis? Right now, our executive risk score is sitting at 42 out of 100. That indicates a moderate risk environment. And this risk is primarily anchored by stretched equity risk premiums and some localized valuation excesses. We're seeing this specifically in the high beta technology sector, even though overall macro liquidity is holding stable. Walking through the specific triggers, you can see that a concentration disconnect carries the highest immediate impact. If we get a mega cap earnings miss that fails to validate the CapEx monetization story, well, that is our primary structural vulnerability right now. We're also closely monitoring potential liquidity friction from treasury auction tails, and of course, the risk of a geopolitical shock if those trade tariffs escalate. This really highlights the tension between our scenarios. The path for our base case relies entirely on a soft landing and solid earnings beats. But our bear case materializes if CapEx fatigue and margin compression decide to collide. If that sticky inflation persists and we get hit with unexpected credit events, it's going to force a rapid institutional de-risking straight out of equities. And the fundamental trigger for that bear case? It's the bond market. U.S. 10-year yields pushing above 4.6% will act like pure gravity on this market. Rising yields put severe pressure on an already over-leveraged consumer base, and they sharply increase the cost of debt for the very capital-intensive industrial stocks we're watching. That's the Achilles heel right there. So the absolute crucial point here is strictly enforcing your capital protection philosophy in this kind of environment. Disciplined execution means using the 50-day moving average as your very first line of defense for tactical trades. And for your longer-term holdings, you treat the 200-day moving average as the ultimate regime break. Capital preservation is the name of the game. As we wrap up this briefing, I want to leave you with one critical thought. Will your portfolio survive the rotation from mega-cap tech into broader industrial cyclicals? Take a hard look at your risk management, tighten your trailing stop discipline, and get prepared for the week ahead. Thanks for joining me for this explainer, and we'll see you next time.